Anton Schutz. He's the president of Mendon Capital and has been covering, of course, Bank of America as well as a lot of other financials. And Anton, I want to get your take because as Eric and I were just talking about, not as big of a stock market reaction or stock reaction to this. And is it mostly due, or is it somewhat due to this home loan portfolio, this $2 billion loss? I mean, give me your take.
Well, I think it's really primarily due to the fact the stock has had a tremendous run over the last 4 or 5 weeks. I mean, it was trading in the $17 range for most of March, and here we are in the middle of April. It's $19.74. So a huge return on the stock and on the whole bank index, and they're all trading together. So, I mean, all it had to do was put up a decent number, and it wasn't going to go down.
No, it certainly wasn't going to go down.
The fact that it's even up is actually good. I mean, the fact that it's had this giant run, I mean, sometimes you just sell on the news. There are a lot of positives you can take away here. Certainly, you talked about the negative on the home equity side. But, you know, the trading revenue number was very, very strong. Certainly a beat there. Certainly some securities gains, but minor relative to things. Most importantly, you know, credit was flat. Charge-offs down. Non-performing assets were flat. You know, the balance sheet is interesting. You've got a lot of accounting noise in there. You've had a lot of assets have to come back onto the balance sheet, so it depresses their equity numbers, but they have plenty of capital. I think that's the most important thing, is all these companies have made it through the woods. Anton,
at what point, I mean, you mentioned the credit loss provisions. I mean, they're down by about $4 billion to $9.8 billion. I'm looking at my numbers here. How much narrower do they have to get before we start to see more normalized earnings at Bank of America?
Well, I think you could see them continue to drop quite a bit. I mean, really what you need to see is loss formation slowing, and indeed it is. Non-performing assets are flat, which means, you know, not new stuff coming into the balance sheet that's bad, which means you don't need to provide for more, and charge-offs are already down. You need to continue to see that trend, and I think normalized earnings become closer than people think.
Now, the other thing that struck me in this report, though, was talking about, you know, those new bank regulations, Anton, we've been following, is going to cut out about $2 billion in fees per quarter, starting in the fourth quarter for B of A. How do they replace that?
They don't. I mean, the problem is some of those new regulations are permanent, and it makes some of their business lines less attractive. Certainly, being a credit card provider is much less attractive to the big banks these days, and I would not be surprised whether it's Bank of America or any of the others, when the market is healthy again, that they don't spin out these divisions, because they really become very low return on equity businesses. And, you know, parts of the company like Merrill, which certainly, you know, down the road could also be potentially spun out, are producing much, much higher returns on equity. And its core business certainly produces higher returns on equity than credit cards. So the credit card business is a lot less attractive to these big banks these days.